I think we've got a great tailwind with the economy, and whether it's, a sugar high from tax reform, I think it does have legs going forward. And if you get these headwinds out of the way, you'll see much, much better economic growth down the road, which will be good for the markets.
Now, Grant, as we talk about the idea that the economy is setting the overall stage for the markets, we are higher because the economy is still good. It's not growing at 7 or 8%, but it's still 2 to 4 or 5%, maybe by some aggressive estimates. Is this, in fact, an environment that the markets can keep on churning higher just because the economy is doing good enough to keep growth sustained?
I think if you got to look at the economy for one point, but you also have to look at corporate earnings growth in the other. And I think that's one of the things that hasn't really been talked about, at least thus far in this conversation, is that earnings growth of U.S. companies have been phenomenal. It's been 20% year-over-year growth for the first 2 quarters. That's the expectations for Q3 as well. The multiple of the market has come down this year, so S&P's at 16.5 times next year's earnings. So if we didn't have the backdrop of this trade back and forth, where it's kind of a 2 steps forward, 1 step back type of scenario every other week, I think the market would have been higher than what it is today, because the economy as itself, as well as the earnings growth picture for U.S. businesses, is still very good.
But Grant, we do have this trade talk as the backdrop. It's here. What does that mean for corporate profits and earnings going forward? They've been good so far, but what if we get this next tranche of the tariffs?
They're not going to grow at 20+%.
And I think if you look at 2019, obviously the growth rate is going to come down as the year-over-year impacts, erode. But from our perspective, we're not in the camp that you're going to have hundreds of billions of dollars of tariffs put in place. And I think to Steve's point earlier, that would be very negative for the economy and for U.S. business as a whole. I think the baseline view for us and many other investors is that it's a negotiating tactic, and I think cooler heads will prevail in the White House to not employ a lot of the tariffs as they're kind of tweeted about day to day.
Why do you believe that?
Well, I think Larry puts it very well, which is, we are an optimistic nation. I think most of the folks that run corporate America are optimists by nature, and if these trade tariffs are put in place, I think you're going to have the White House phone ringing off the hook, recognizing the negative implications that it has for U.S.-based businesses.
Guys, I just want to call your attention to the fact that we are now at session lows, off by about 0.4% for the S&P 500. In the wake of those comments from Larry Kudlow, the chief economic advisor to President Trump, Lou, we want to kind of put a cap on this, put a point on this with you. As a portfolio manager, does this change the strategy, the means by which you employ that capital that you have? Do you change your overall thinking of how you invest because of these trade issues that are happening?
From our perspective, no. But at the end of the day, if it would be only a fool would think that a full-blown trade war wouldn't have a big impact on the equity markets. But again, going forward, we think cooler heads will prevail and something will get resolved. Now, if we look into 2019, where do we see the best opportunities? They still lie within secular growth opportunities. And I think those are the types of names or companies that you can buy in good times and in bad. So you don't have to try to make that big macro call to find the winners and losers in the market.